everyone, I'm Maria Hanamia and I'm a student of MBA September 2023 IPMI International Business Svhool. And now, I'm going to share you about the corporate finance subject lectured by Prof. Sembel MBA Ph.D. And here we go. Okay, well, before we are going to discuss more about the corporate finance subject, I will explain what is the corporate finance itself. So, corporate finance is a field of finance that deals with the financial decisions made by corporations and the tools and analysis used to make these decisions. Okay, well, in here, I will divide the corporate finance subject into 4 parts. The first one is Introduction to Financial Management and Time Value of Money. The second one is Capital Budgeting. The third one is Analysis Security and Dividend Policy. And the last is Fraud Risk Management and Corporate Restructuring. Okay guys, in here, in financial management, we will discuss about some parts. The first one is cash flow management. It's a method of evaluating securities by analyzing statistical trends gathered from trading activity, such as price movement and volume. The second one is financial security. It's referred to the state of having a stable and reliable financial situation that provides a sense of confidence and peace of mind. And also, we learn about the risk reduction. It refers to the process of minimizing the likelihood or impact of potential risk within a specific context, whether it's in a business, finance, health, or other areas. And the next is managing capital. It's the strategic deployment and allocation of financial resources to achieve the objectives and goals of an organization. And also about the CAPM, or the Capital Asset Pricing Model. It is a financial model that establishes a relationship between expected return on an investment and its systematic risk. And the formula is RE equal RF plus beta times RM minus RF. And the next is portfolio theory, also known as a modern portfolio theory or MPT. It's a financial theory development and that provides a framework for constructing an investment portfolio that maximizes expected returns for a given level of risk, or alternatively minimize risk for a given level or expected returns. Okay, the next one is the 5 key elements of business according to Professor Ramchara. The first one is cash, second is profit margin, velocity, growth, and customer focus. And the next one is adverse selection. Is a term used in economics and finance to describe a situation in which one party in transaction has more information than the other party, leading to imbalance in quality of information. And the last is bond yield. Is a measure of the return of investor can expect to receive for holding of a bond. Okay, the next thing that we will discuss is about time value of money. Time value of money is a financial concept that recognizes the idea that a sum of money has a different value today compared to its value in the future. And here we learn about the rule of 72. It's a simple mathematical formula used to estimate the number of years it takes for an investment to double in value at a fixed annual rate of return. And the formula is 72 divided annual rate of return. In the second part, we'll learn about capital budgeting. We will learn about the net present value or NPV, payback period, interest rate of return or IRR, and the profitability index. In NPV is a financial metric used in capital budgeting to assess the profitability on an investment. It represents the present value of expected cash inflow minus the present value of expected cash outflows over a specific time period. Payback period is a simple financial metric used to evaluate the time it takes for an investment to recover its initial cost. It is the amount of time required for the cumulative cash inflows to equal the initial cash outflow or investment cost. And the next one is IRR. It is used in capital budgeting to evaluate the profitability of an investment. It represents the discount rate error with the net present value. And the last is profitability index, also known as investment ratio or PIR. Is a financial metric used in capital budgeting to assess the attractiveness of an investment. It is calculated by dividing the present value of expected future cash flow by the initial investment cost. Okay, the next part is analysis of securities. In here, I will divide it into some parts. The first one is technical analysis, the second one is fundamental analysis, and the last is financial statement analysis. Technical analysis uses historical price and trading volume data to evaluate and predict future price movements of financial assets like stocks, currencies, commodities, and inputs. In here, it's like momentum versus reversal, trend, uptrend, downtrend, support resistance. The gap, it's like common breakaway metering and exhaustion gap, and the last is triangle symmetric and asymmetric. The second is fundamental analysis, aims to evaluate the financial health, performance, and potential risk of an asset to make informed investment decisions. It's like domestic and global economic analysis, industry analysis, and company analysis. And the last is financial statement analysis, involves examining of company's financial statements to gain insights into its financial health, performance, and overall viability. It's like components are the as shown afterward. The outs show how profitable it, and the cash flow show the cash. And the second is ratio, it's profitability, liquidity, activity, leverage, and market. And the last is to measure healthy or not. And we move to the dividend policy. I divide it into three parts again. The first one is payout ratio, the second one is dividend stability, and the last is tax benefit. Payout ratio calculates the percentage of company earnings paid out as dividends to shareholders by dividing total dividends paid by the company by its net income. And the dividend stability refers to the consistency and predictability of a company's dividends payments over time. And the last is tax benefit. It's our advantage or savings provided to individuals or business due to specific provisions in the tax code. Okay, different management. The first one that I want to explain is about the triangle of work. It's like you can see on the screen. The first part is opportunity. It's like with internal controls, ineffective control monitoring, and also the pressure. The pressure is a great addiction for cash management and dissatisfaction with pay overlook for promotion. And the last is rationalization. It's like I deserve a pay rise. And we move to the second one of fraud risk management is occupational fraud and abuse. It's like asset misappropriation, cash, inventory, and all other assets. The second is corruption. It's like involves employees abusing their position of power for personal gain, often through bribery or tax. And the last is financial statement fraud. It's like manipulating financial statements to deceive stakeholders about the company financial health. And the third is investment fraud. It's like involves misleading individuals or entities into making financial investment based on false or misleading information. And the fourth is fraud detection and prevention. It's like organization use internal controls, segregation of duties, employee training, whistleblower hotlines, and audits to prevent and detect occupational fraud. And the last that we learn in investment fraud is about the 7 financial shenanigans. It's like recording revenue too soon. The second is recording bogus revenue. The next one is boosting income with the one-time gains, shifting current expenses to a later or earlier period. And the fifth is failing to disclose all liabilities. And the next is shifting current income to a later period. And the last is shifting future expenses into the current period. Our last part is corporate restructuring. Corporate restructuring refers to significant changes made to the structure, operations, or financial status of a company. In here, we learn about the study case of LBOR GR Nabisco. And the core of the study case is LBOR GR Nabisco has become a landmark in financial history and provides profound insights into the strategies and challenges involved in large-scale LBO transactions.
Okay guys, I think we are in the end of this video. So the biggest lesson learned from this class, which is the Corporate Finance class, lecture by Prof. Sembel MBA Ph.D, I've learned if everybody always make mistake. So don't worry for make mistake, as long as we get up again and fix it. So thank you for watching. I hope this video can be useful for all of us. And don't forget to like, comment, and subscribe. Bye!